Almost everyone has at least one relationship with one financial institution. Practically all businesses, regardless of industry, require financial services at some point in time, be it credit cards, bank and time deposits, loans, insurance, or investments. But financials go beyond these. It evolves through technology, and rapid innovation has given birth to a long-term trend called fintech or financial technology. Fintech is a powerful trend. Electronic payments are steadily growing with a lot of room to grow exponentially. On top of this, we also have the rise of cryptocurrency and other blockchain technologies. With the Atrium Global Financials Feeder Fund, investors can participate in the growth of companies around the world that are involved with providing financial services. The fund gives you access and diversification to global financial names that we normally do not have locally. The fund also invests in fintech, which a normal financials fund would not. Invest in the biggest global companies in the financial industry. Participate in the global recovery. Diversify your investment portfolio by investing in this fund. Invest in the Atrium Global Financials Feeder Fund. For more information, visit www.atrium.com.ph.
The world around us is ever-changing. We are facing development challenges on a global scale. Today, 41 million out of 57 million deaths are attributable to non-communicable diseases. In the Philippines, 5 out of 10 families were deprived of basic education. The Philippines also ranked 3rd in the top 10 countries with the most natural disasters. Women participation in the labor force is less than half at 48%, while male participation is at 77%. The United Nations identified and adopted 17 Sustainable Development Goals or SDGs to address the challenges faced by economies, societies, and the environment. We at ATRAM support the UN and the SDGs by launching the ATRAM Philippine Sustainable Development and Growth Fund. The fund is designed to invest in Philippine companies that score high in terms of the integration of UN SDGs into their operations and strategy. Through this fund, we hope to encourage PSC-listed companies to integrate UN SDGs into their businesses. We must work together to make a world a better place. ATRAM Philippine Sustainable Development and Growth Fund. Invest in a sustainable future together. Invest to thrive. Invest together. For more information, visit www.atram.com.ph.
Right. Hello, everyone. Thanks again for joining us this morning. Allow me to introduce myself. I am JP Chong, Business Development Manager from Atrium, and I will be your host for today. Global investing has become vital for portfolios as we take part in the global growth story. It can offer performance-enhancing opportunities missed by single-country investors while narrowing the risk brought about by domestic economic and market forces. Stay tuned as today's webinar will focus on the significant benefits of global investing and strategies that can help you tap into new prospects for growth and harness the potential increased significance of the emerging markets. If you have any questions, you may send them as early as now by clicking on the Q&A button below your screen. Before we begin, I'd like to let all of you know that this session will be recorded and that the copies will be disseminated as well as posted on all our social media platforms. Also, please don't forget to visit our website, that's www.atram.com.ph, for a more detailed information about all the funds that we offer. If you have any friends who you think would like this webinar, but are unable to attend, feel free to share the YouTube replay of this session. You may do so by visiting our YouTube channel, that's Atrium Studio. You can scan the QR code to visit all our official social media pages. Would like to invite you to join Atrium's official Viber community group, that's #AtriumPH Community, to stay updated on the latest announcements, advisories, and reminders. You may do so by scanning the QR code or visit the link on your screen and get a chance to win Atrium merchandises. We'd like this webinar to be as interactive as possible, so please do not hesitate to send in your questions. You may do so using the Q&A tab all throughout the webinar. Each question you send is a raffle entry for a chance to win limited Atrium merchandise. Winners will be announced at the end of the webinar, so make sure to stay until the end. We will also be wrapping up with a quick feedback survey after the webinar. So we do hope you can share your thoughts with us about our session for today and how we can further improve our webinar series. Without further ado, we can start now. We can start the webinar. It is indeed a privilege and a pleasure to have with us today BlackRock's Vice President and Product Strategist, Andy Nielsen. Andy is a member of BlackRock's Global Allocation Fund. As a product strategist, he is responsible for representing the investment team on a global basis to both retail and institutional clients. Andy's service with BlackRock dates back to 2010, when he began his career as an analyst in BlackRock operations. Andy earned a BA degree in Communication and Media Studies from Goucher College in 2009 and was awarded cum laude. Andy also has a master's degree in business management from Durham University in 2010 from the United Kingdom. Now, let us all welcome Andy.
Hey, good morning, everybody. Look, before we begin, I just wanted to take a quick moment to thank the folks at ATRAM for organizing this event and for all of y'all that are dialed in today. On behalf of the entire Global Allocation team, we generally and genuinely appreciate the support. So thank you very much for your time. What I wanted to do was turn over to the market outlook section and spend about 15-20 minutes going through how we're thinking about the world today. You know, if we open up to slide 4, what I'm trying to do on this original page is really summarize up front what our view of the world is today. And what we're going to ultimately do is use this summary as a backdrop for the rest of the comments that we'll make throughout the rest of the presentation. So at a very basic level, one of the things that we are focusing on is that we remain overweight risk assets. Now, we've recently started to reduce our overweight to equities slightly, but ultimately we believe that equities are the best source of value across the capital stack today. And I'm going to get into a number of reasons why that's the case momentarily, but a huge component of it has to do with the tremendous amount of financial stimulus that we've seen pumped into the global economy since the start of the pandemic. At the same time, this more optimistic view of equities is leading to a more cautious view on fixed income. And as a result of that, what you're going to see is us holding far higher levels of cash when we think about how we're building protection into the portfolio today. And I'll get into some of that element as well. And then the last thing I want to talk about, because you're going to hear us thinking about this pretty frequently, is finding ways to participate more on the upside and try and help limit some of the downside. And one of the ways that we do this is via the volatility markets. And our very simple view here is this. If you listen to Bloomberg or CNBC, you'll hear the term volatility used quite often. And while it is often discussed as an efficient portfolio tool, it's not often utilized. And that's something that I think people want to ensure that they're following, because it's a very effective tool that we have in our toolbox to be able to use. So if we move on to the next slide, I think it's really important for us to focus on this page. And why that is the case is because it helps to tell the story as to how we are today and where we came from. And I think this is really critical as we think about the next phase of where we are. One of the cases that we've been making, and I think that this slide does a nice job of illustrating, is that in today's market environment, markets are moving faster than they've ever moved before. And there's more volatility than we've seen in previous decades. And so a lot of this means that building flexibility and finding what regime we're in today really matters. But again, it's important to understand how we got to where we are today. And so to do that, I want to take a quick trip back to 2018, because in many ways, this created the start of the market environment that we're in today. And what I mean by that is we started to see the return of volatility after almost a decade of absence. So to run through this quickly, if you can just take a moment to kind of cast your mind back to mid 2018. If you think about the US markets in particular, they were positive, but it was a very narrowly led bull market. And what I mean by that is only a handful of stocks were contributing to the entirety of the market related gain. At the same time, we had a newly appointed Fed chairman by the name of Jerome Powell. Today, he's a household name. Back then, he was somewhat untested. Now, in the face of slowing global growth, what ultimately happened is that Chair Powell made what may be considered one of the early policy mistakes. And that was during a press conference, he came out and he said that the Fed was basically on autopilot with the hiking of interest rates. Now, this was against a global backdrop of slowing growth. And so, with a new Fed chairman, slowing growth, the market sold off precipitously. And actually, 2018 is a really interesting year because the breadth of the sell off was one of the worst that's been tracked in the last 100 years. Not the depth, but there were very few places to be spared back in 2018. And so what happened then, we roll forward into 2019, and a lot of investors came in underweight risk, and they were very concerned about global growth prospects. But something important happened, and that was that the Fed did a complete 180-degree turn and started to signal interest rate cuts. And then they started to cut rates. And what's really important about this, though, is it was not just the US central bank, it was global central banks. One of the things that we often hear and market participants talk about is that central banks are too slow to react. And we'll get back to that concept back in 2021, because I think that sort of behavior has resumed. But in 2019, we saw global coordinated policy. And so you had a really strong year in terms of equity returns. And importantly, the expectations for global growth going into 2020 were quite strong. And then the pandemic hit. So we ultimately know that disrupted everything. And what then happened was a series of very shortly lived regimes, each with a very distinct playbook. And that's what we're summarizing here. And so what happened, basically you had regime one. There was all of a sudden the pricing in that there's a global pandemic. So what do? You go to cash as quickly as possible. Step two was there was a tremendous amount of central bank policy and fiscal policy. So what do? You follow the central banks. You buy what you know they have announced that they're going to buy. Once that created richness within certain asset classes, part three of the playbook was get out of those and rotate into what's considered some of the lower quality assets where there was still a decent amount of income on offer. Think of high yield. Now, it's that fourth regime that I think is really interesting because it's been much longer than the context of the first three, but still shorter lived than a normal environment. And one of the things that we're really contending with today, and this is really prescient timing as we're discussing it, is that we're getting ready to enter this phase where the Federal Reserve will start to reduce the amount of assets that they purchase each month. If we move to the next slide, there's a lot to be made about the potential for another taper tantrum. And if you think back to 2013, things are vastly different today than they were back then. And I think that's really important. And it's also really important to remember, while the thought taper tantrum is in the back of many investors' minds, what actually happened during that period of time? Well, by the end, employment continued to do well. Manufacturing continued to do well. And the stock market, though it had a short blip, ended up doing really well. And what I think is really important to remember, because this is about to happen probably in the coming weeks or months, is that the Fed's tapering is not necessarily a tightening of policy. We don't expect them to start raising interest rates until much later. But what's really important is it's moving off of emergency levels of accommodation to still very easy levels of accommodation, which should ultimately help benefit some of the risk assets. So one of the questions then becomes, does that take out the concerns about overheating and inflation, and should we be worried? Now, in short, we think what you really need to do is to put this into perspective. While the markets want to focus on taper or the size of the taper, here's a few things I think you should really consider, because in the broader scheme, the taper, when we think about the actual amount of issuance that's coming into the market today, makes 2021 vastly different than that environment in 2013. And so if I can draw your attention to that upper right-hand screen, this is what I'm talking about. The market today recognizes that there's a good deal of supply coming into the market, and that real rates, or rates less inflation, have been too low for too long. And that's because the amount of the stimulus that's been in the system has kept much of the fixed income market way too low from a yield perspective. And in fact, it's one of the areas that we do remain relatively concerned about. And that's why we're starting to see and expect real rates to go higher. What's really important about that is that negative real rates today, even if we got up to zero real rates, which would be a move of 70-ish basis points from where we are right now, ultimately, that would still be more accommodative than the last 20 years. Point being, while there may be some hiccups and some volatility along the way, at the end of the day, it's still extraordinarily easy, accommodative policy. And that's going to be really important how we think about what should happen. And in fact, we continue to make the case that actually the Fed could have and should have began to taper months ago. So to lean onto this a little bit more, if we move to the next slide, I just want to illustrate mentally the lack of yield on offer if you consider a fixed income portfolio in 2001 that had a split of roughly 60% IG and 40% high yield. At that period of time, that portfolio would have given you as a client a yield of 9.15%. Now, if you fast forward to where we are today, that same split would only give you 2.7%. Now, consider that in the context at the start of 2020 that a 10-year risk-free treasury yielded 2.5%. And you can see why that information matters. And what we're showing is here that the market today just looks vastly different than it did 20 years ago. Again, everything that you do matters in a much different way. And part of this has to do with the dissemination of information, how quickly the markets move and react to new information. So what this means for much of the fixed income market today is that it's not really attractive. And we ultimately expect fixed income to continue to go down as rates grind higher. But there is something to keep in mind, that there is this insatiable demand for yield. So while yields are ultimately, or interest rates are ultimately going to go higher, there should be a cap to where they ultimately go because the demand is so significant. But coming back to high yield for a moment, this is really interesting. And on the credit side in general, while investing in some of those markets today does not make sense from a spread or price perspective, what it does do is make the equities of those companies that much more compelling. And the very simple reason for that is this: if I, as a company, am able to issue debt at extraordinarily low levels, it is a direct injection of value into my stock price, into my company, because I can use that debt to focus on R&D, on M&A, on implementing new technology within my company to help efficiencies grow. So this is really important. But alongside all of this, one of the things that people are really concerned about is inflation. So if we move to the next slide, you hear this time and time again. Inflation is probably going to be transitory. It's transitory, it's transitory. But what does that mean? To us, we do believe that inflation is going to be transitory, but how you define transitory matters. So what we think is that you're going to see stronger inflation prints over the next year for sure. The supply chain bottlenecks are not going away. In other words, inflation is here. No matter what you use to measure it, inflation is higher than it was anticipated. And part of this, again, goes back to that supply chain bottleneck. And ultimately, that should, over time, begin to work itself out. But the big story to us really has a lot more to do with this concept of supply-demand imbalance. And this is really important because demand is really strong, but the supply is really challenged. So what this is doing is it's leading to friction in the labor markets, and it's really, really hard to hire workers today. So what we're starting to see is some wage pressures. So against that backdrop, a very fair question is, then what's going on in the US with the economic data recently? Why do we have such a large miss in NFPs in August and September? And does that foretell a stalling in the economic recovery? And our view is that no, it does not. And so if we move to the next slide and we focus on what the good was embedded within the numbers. So in September in the US, the unemployment rate declined meaningfully from 5.2 to 4.8% in September, with average hourly earnings seeing a sizable increase and year over year being up about 4.5%. So what ultimately happened is more of this supply-demand imbalance. There's just not enough people coming back to the workforce fast enough, which is why wages and average work week are increasing. It's also why we think that the Fed should have begun tapering. And this is going to have really big implications for companies that you want to be invested in as well, because some companies have done a far better job of being able to adjust to the modern economy with this labor shortage. So moving on to slide 10, we've talked about the concept of stimulus, we've talked about inflation, and we've talked about why the Fed should ultimately reduce its asset purchase program. But if we spend an extra moment on the consumer, particularly the US consumer, I think this gets to how we're thinking about constructing portfolios in the world today. So one of the things I want you to consider is the fact that in the US, which is a consumption-dominated economy, households now hold $2.5 trillion more than they did before the pandemic. Globally, this is over $5 trillion. So this is really important because not only that, but consumers are also in a really good place from a debt servicing standpoint. In other words, they used the opportunity over the pandemic with their savings to pay down the debt that they have. So we've never seen such high household wealth with such low debt ratios. And this is really important because this concept of consumption and these themes around consumption are going to help drive asset allocation decisions going forward. And moving on, it's not just the consumers. So think back to the corporations as well. And there's several reasons why the corporations are in really good shape and why earnings season is going to be so important over the next few weeks. If you think back to the start of 2020, companies have very rationally cut back their manufacturing. That's leading to some of the supply imbalances that we have today. So at the same time, you had the inability to get capacity due to those supply chain bottlenecks. Getting merchandise from this part of the world around Asia back to the West took much longer. So delivery times have gone up. You know, if you try and purchase a mattress today in the United States, you can be on backlog until the spring of next year. So these pressures are not going away overnight, but the companies that are able to navigate this are the companies that we're going to want to ultimately focus on. And so now, months later, when we see the supply chain bottleneck come back and you think about the earnings and economic growth, the question could become, well, does this derail the point that you made about the Fed normalizing interest rates? And we don't believe so. So the next point of that then is you have normalizing interest rates. Well, isn't that bad for stocks? So if you move to the next page, one thing that I think is really important is the context of what is creating higher rates. And will stocks do well in a higher rate environment? And the answer is yes, because it depends on what is causing the increase in rates. Right now, it is growth driven. We're seeing strong global growth. And yes, some of the numbers have been revised down in 2021, but what's really happened is they've been carried forward into 2022. So you should be okay from a growth standpoint as well. And what that means is that we'll be able to see companies that are still able to generate real and meaningful growth in that environment because the economy's growth is going so strong. So, wrapping all of this up, if we move to the next slide, and how we think about constructing a portfolio and overall asset allocation. So, you have to remember that over the last 20 years, the correlation of stocks and bonds was negative. What that meant was that bonds were a really good hedge in your portfolio. They would help dampen the volatility that might otherwise be seen from all these economic growth scares, from some of the earnings misses, et cetera. But today, that's not necessarily the case. They'd, as bonds and stocks are moving together, what you can see in this slide is that increases the volatility of a potential portfolio. And so one of the things that we're doing and really focusing on is building resilience into the portfolio, not just buying a slug of US treasuries, but finding equities that are really quality companies and allocating accordingly. So this is areas in retailing, media, large industrials, manufacturing, and technology. So these are areas we think can outperform over the next 3 years. And to leave you with a final point on the equity side of the book, if you think back to my comments a few moments ago and the ability for a company to finance and spend on R&D and how that impacts their future, I'm going to just give you one example. And this isn't a stock recommendation, but this is a really staggering company idea, which is a company like Amazon. At the heart of Amazon's success is an R&D budget that is over $36 billion a year. And over the last decade, that has grown by roughly 44% per year. So when we talk about harnessing the power of technology, the companies that can do just that and focus on R&D and focus on the next generation of the economy, those are areas that you really want to be focused on, and something that we're going to be highly focused and leaning in towards over the next 3 to 5 years. So with that, I just wanted to say thank you again. And
Thank you very much, Andy, for that very insightful discussion on the global market outlook. Before we proceed to the next part of the webinar, we'd just like to remind everyone that if you have any questions, you may send them as early as now. You may do so by clicking the Q&A button below your screen. So please do not hesitate to send in your questions all throughout the webinar. Remember, each question you send is a raffle entry for a chance to win limited ATRAM merchandise. Winners will be announced at the end of the webinar, so make sure to stay tuned until the end. And now, to give us an overview of the Atrium Global Allocation Feeder Fund, a fund that invests across the full spectrum of global assets available, providing growth of the global economy with less risk, we have Atrium's Product Development Manager, DJ De Jesus. As a Product Development Manager, DJ identifies potential new product opportunities to continue Atrium's legacy of innovation. Hello, DJ. The floor is now yours.
Thank you for the introduction. And of course, thank you to Andy for gracing us with your presence and providing insights on BlackRock's global outlook and asset allocation strategy. And we are very lucky that the overall outlook and strategy is wrapped under the ATRAM Global Allocation Feeder Fund. The fund is a global multi-asset feeder fund that dynamically manages across global assets, including cash, fixed income, equities, among others. The fund allocation is on average 60% equities and 40% fixed income. So the fund is perfect for those who are near 40 years old and want someone to simply manage their assets for them. If you're a bit younger, you can of course add the ATRAM Global Equity Opportunity Feeder Fund, which was discussed last week, or our comprehensive list of equity funds to augment the equities allocation. The objective of people looking to buy this fund is capital appreciation and growth, as opposed to our ATRAM Global Multi-Asset Income Feeder Fund, which is income. And soon, We will be launching a Philippine peso unit class for this fund. You heard it right. This fund that lets you sit tight, relax, and let the biggest asset manager in the world, BlackRock, manage your money for you. Here are 3 reasons why you should think of investing in this fund. First, the fund is flexible, providing you access to a diverse range of asset classes managed dynamically to fit the prevailing market environment. Second, the fund is competitive, giving you near global equity-like returns with less risk. Third, the fund has a think tank creme de la creme team that leverages on BlackRock's vast resources. As you may know, BlackRock is the biggest asset management company at around $8.5 trillion in assets, and the people running this target fund are the best of the best in BlackRock. The team manages BlackRock's over $18.5 billion or so, and this fund is BlackRock's flagship multi-asset fund. So, of course, they'll devote their best resources to the fund. On this slide, we show just how flexible and dynamic the allocation of the fund is. Each color in the graph represents an asset class, and you will notice that the allocation to any one asset class isn't static. And the team has had a good track record of getting the calls right. For example, after the dot-com bubble, and yes, it shows how old the fund is, they increased their allocation to US equities, which was the right call after a big sell-off. And just to preview something for later, the current lead portfolio manager, when he assumed the post, decreased the cash position significantly to take advantage of the other asset classes back in 2019. The target fund over its life has delivered very competitive returns. Since it was born, the fund has provided an average annual return of 7.3%, which is not too far from global equities with an average annual return of over the same period of around 8%. Not too far, right? But they have done this with one third less the risk. The risk of the fund over its life is only 10.4%, while global stocks have a volatility of 15.7%. Truly, the fund is able to keep up with equity-like returns, but with smaller degrees of potential losses. More to gain and less to lose. Sounds good, right? And what's more, when global stocks are up, it could capture on average 65% of the gain. But when global stocks are down, it would only capture around 54% of the losses. There's really more to gain and less to lose. As stated, the fund has a think tank team of BlackRock heavyweights, and I'll introduce the 3 biggest players of this fund. Rick Reeder is the lead portfolio manager and head of macroeconomic strategy of the fund, but he also serves as BlackRock's chief investment officer for fixed income. This is very relevant because fixed income people are one, focused on the macroeconomy, which makes him a good fit for being the head of economic strategy, and two, used to manage market losses while spotting opportunities for market gain. I might be butchering his name, but Russ Kostrik serves as the fund's head of quantitative strategy. In BlackRock, he is also one of the key people involved in quantitative strategies, which gives the fund an edge of finding the right times to buy and sell securities, but also to manage risk. Finally, we have Kate Moore, and she is the fund's head of thematic strategy. She previously served as BlackRock's head of equities. So you can clearly see that with Rick Reeder, you have a good balance of fixed income and equities in this multi-asset fund. Plus, being the head of thematic strategy, the fund is able to identify the prevailing market themes and capitalize on them, just like we discussed last week. Together with David Clayton, these 4 portfolio managers manage the allocation of asset classes. This team is backed with a roster of experienced and dedicated analysts that do macro research, fundamental security selection, and quantitative strategies. Each of these blue squares represent a team per equity sectors, and each of these orange squares in the middle represent a team per fixed income sectors. The fund also leverages on the breadth and scale of BlackRock through the BlackRock Investment Institute, which is in charge of the long-term return and risk assumptions of the firm, Aladdin, their comprehensive portfolio management, trading, and risk management platform, and other analytics such as trading and liquidity and risk and quantitative analytics. Currently, the fund prefers equities over fixed income with a 7% overweight in equities and 24% underweight in fixed income. The rest is mostly in cash. In equities, the fund currently prefers the following regions: the US, developed Europe, and emerging Asia, while being underweight in Japan, Australia, and Canada. It also currently prefers the following sectors: consumer discretionary, communication services, industrials, materials, and energy. The first two are growth plays, while the last three are reopening plays. In fixed income, it prefers corporates and securitized assets to provide more interest income while being underweight government securities due to the overall rising interest rate environment. And I think the performance of the fund should speak for itself. Since we launched the feeder fund in 2014, converted to peso terms, the fund has gone up 70.25%. That gives you roughly 8% year on year for the past 7 years. But remember that while past performance does not guarantee future performance, the fund has shown that it is very consistent in delivering good returns. So invest in the fund that helps you build resilience through adaptive asset allocation. Invest in the Atrium Global Allocation Feeder Fund. The peso unit class will be available on October 27 via Cbox for as low as 1,000 pesos. We are happy to provide funds like this. This fund manager can act as your personal portfolio manager, so you won't need to do the work yourself. All you need to do is save and invest. And with that, I turn the floor over to JP so Andy and I can answer your questions.
All right. Thank you very much, DJ, for discussing to us ATRAM Global Allocation Feeder Fund. We'll now move on to the Q&A portion of the webinar. We'll be taking the live questions from our audience. We received questions earlier during the first part of the webinar, and we have several questions that are coming in as well. I'll invite again Andy and DJ to help us with these questions. Just to start it off, I think the first question is for Andy. So, what are BlackRock's views on emerging markets, global real estate, commodities, and various alternative asset classes? Andy?
Yeah, hey JP, thanks, and DJ, thank you as well. So look, I think these are going to be great questions, and I'm looking forward to trying to do my best to answer them. What I would say is right now, as we think about emerging markets more generally, we're focused a bit more on emerging Asia. But as we showed within emerging Asia, one of those areas that we've been invested in a little bit more heavily has been China. Now, China is an interesting one because there's obviously a regulatory regime that we need to contend with. And we need to always take that step back and think about, well, what is each investment decision we make due to the overall risk profile of the portfolio? Simply put, we do believe that we need to be cautious on a lot of emerging market securities today, primarily just because of the unevenness of the reopening trade that we're seeing around the world. So that's where our emphasis to areas like the US, focusing on quality companies, of which the majority of those quality, these are companies with strong balance sheets, earnings consistency, and ability to grow free cash flow. They're predominantly located in the US. Our overweight to Europe reflects our view of the cyclical reacceleration, although we've started to trim that positioning as well. So when we take all of that combined, and then you think about where we are in the energy space, we had gone from a pretty material underweight to energy. And now as we look around the world, particularly in some of the developed world, in an area like the UK, for example, you're seeing this energy supply demand dynamic really play out. And what do I mean by that is there's been a big shortage of supply, and the demand has just continued to outstrip it. So we think that energy is going to be an area that we can focus on. But again, going back to that risk-aware mandate, all of the decisions that we make are to add in selective risk into the portfolio. So you're never going to see a material overweight to emerging markets, not within the context of the overall risk mandate of the fund.
All right. Thank you very much for that, Andy. I think the next question is for DJ. DJ, would you recommend this type of fund to beginner investors?
Hey there, and thank you for everyone joining. We actually want to release this fund, and why we're relaunching it is really because this fund is the beginner fund. It allows you to basically allocate your assets across the globe through one fund, and that's perfect for a beginner. There is an age range, so this would be perfect for someone who's around 40 years old. Of course, if you are slightly younger, then you could add more to the Atrium Global Equity Opportunity Feeder Fund, which was discussed last week. Or you could add to the Atrium Global Multi-Asset Income Feeder Fund. And those are ways that you could really adjust your portfolio and be able to start your investment journey. But that said, this is one of the best or the best beginner funds that you can go to, especially because BlackRock has had a long history with this fund, as I discussed a while ago. And this fund also has a good long track record in the sense that if you're looking for return with less risk, this is one of the funds that have performed very well and is known worldwide. So we are very happy to be launching this fund for the beginner, for those that are just getting into their investment journey and want a fund that they can start on.
All right. Thank you very much for that, DJ. It's really nice to know that we have a fund that for those beginners who just want to start their investment journey, we have that here in ATRAM. All right. For the next question, I think this one is for Andy. Andy, would the U.S. wage inflation be a better measure for growth compared to, say, inflation of the employment rate?
Yeah, look, I think that's a really good question as well. One of the things that, if you had asked us 6 months ago how transitory was inflationary environment going to be and what does that look like, it's important to remember there's still a number of unfilled jobs in the United States. The jobs openings are one of the highest that we've seen in recent years. And the issue there is getting folks into the labor force. So yeah, we do believe that you could see some stickier wage growth, but I think it's really important to put that into the broader context of the amount of stimulus that's in the system. And what I mean by that is one of the questions that we've been getting has to do around that concept of stagflation, where you have high inflation and low growth. And this is the complete opposite of that. We actually have really strong demand. We see this coming in the form of inventories being drawn down from a company level. And what we're also seeing at the same time is a really strong spend on CapEx. In other words, companies are expecting this growth to continue. And what we ultimately believe is we're going to see this above trend growth and that's going to continue. And that's something that we really want to ensure that we're leaning into. We just came off of seasonally one of the worst periods for investing, and we're about to enter one of the seasonally best periods for investing. You're starting to see this in some of the earnings numbers. And one of the things that we've been really focused on is listening to what companies are talking about. A lot of the companies have done a really good job of adjusting their business models to ensure that they don't necessarily have to pass through all of those costs to the consumer, but at the same time, demand is strong enough that it's not going to abate. So one of the things that we're definitely focused on is what does that inflationary environment mean? But we do believe that growth is going to accelerate beyond that. What we're really focused on, as I had mentioned, though, is the Fed beginning to normalize policy. The reason we think that that is so important is even though we expect above trend growth for the next couple of years, what we think is really important is that the tools available if a mid-cycle adjustment needs to be made, are available. And I think that that's really critical. So that's one of the things that we're looking at today and focusing on as we're allocating risk within the portfolio.
All right. Thank you very much, Andy, for that insight. Moving on to the next question. I think this one is for DJ. What is the impact of foreign currency on the fund? Will the peso unit class be exposed to the movement of the US dollar?
Well, to answer your question, basically this fund is already invested into multiple currencies. When they invest into stocks globally, they don't hedge the currency back to the US dollar. And for the peso unit class, that's also not hedged. So you will be able to experience some of the volatility from the different currencies. However, given that we are dealing with a lot of equity securities, in fact, on average, that would be around 60% equity securities, that currency exposure would be muted. So there will be some exposure to the dollar, and it will benefit. The peso unit class will benefit if the dollar appreciates, but at the same time, it's really more exposed to the equity securities and other securities that are invested in by the target fund, the Global Allocation Fund.
All right. Thank you very much for that, DJ. Moving on. I think this one is for Andy. A follow-up question, if you will. How do you do due diligence or choose which companies to invest on in the fund?
Yeah, so this is, I'm going to try and answer this question in a sort of multi-tier approach. Kind of going back to some of the comments that DJ made when he was talking about the structure of the portfolio managers and the way that we think about the world. So one of the things that we focus on is that global allocation is not a fund-to-fund strategy, meaning that every single investment in the portfolio is hand-selected by the global allocation team. And one of the ways that we get to those individual securities is to start with some of the macro framework. In other words, where in the world do we think are what we call the fast rivers of growth? In other words, where are the areas that are set to grow the most? Because when we allocate to our equities, what we want to ensure is that we're allocating to the most efficient part of the equity market. So we're starting to think about that at a high level. Where in the world do we want to go? And then we think about overall asset allocation. How much equity exposure do I want today? How much equity exposure do I want as we think about the next several months as well? And then finally, one of the things I think is really interesting about Kate Moore's role is Kate then helps us with a framework of what are the themes, what are the areas that we want to invest in from a sector standpoint. And then we piece all of that together, and David Clayton works very closely with our individual analysts from the bottoms up to find the companies within those sectors and countries that we think present the best opportunities. And one of the things I had mentioned that we're really focused on today is the concept of quality. And that is because quality companies tend to do really well, agnostic of the business cycle. We know that there are still risks that are in the system, but we believe that the companies that are able to grow their cash flows, that have demonstrated consistent ability to grow cash flows, and areas that have used technology to enable their businesses to continue to grow are areas that we want to be invested in. So it's not just technology, it's technology enablement as well. So we're looking at a number of traditional metrics, such as what is the cash flow that's being generated, what is the R&D and CapEx budget, and how are the board of directors of these companies utilizing all of their resources and focusing on expanding their margins. So that's how we're thinking about the world, and then how each of those slots pieces together as we find the companies that we build from a line item by line item basis to construct the overall portfolio.
All right. Thanks for that, Andy. Actually, the next question is directed to you both. So maybe DJ can start it off and Andy can just follow through. Does the fund consider any ESG filter in choosing the companies?
Okay, so I will begin with saying that this global allocation fund, one of the reasons why we're very happy with it is it's already beginning to incorporate ESG into its investment strategy. And BlackRock is also known for a different ESG fund globally as well. So they're one of the pioneers in the space. And I think I could turn it over to Andy to explain a bit more.
Yeah, I think that's a really good question. It's one that we're asked more and more frequently. And there's a number of steps that BlackRock has taken to incorporate ESG into the investment process. Now, ESG is not the sole focus of the global allocation strategy, but we do believe it's an important input. One of the things that the team has built over the last several years is a proprietary system that is actually exclusive to the global allocation team. And what this proprietary system is a research portal within the fund. So it shows all of the different inputs, whether it's from a buy target, a sell target, the amount of exposure we want to take, the investment thesis. Also fed into that portal is the ESG scores. So we're looking at those very comprehensively. Also, the team launched back in the US what's called a closed-end fund, which was the ESG Capital Allocation Trust. And so, the team has extensive ESG capabilities, and we're able to use those as screens and additional inputs into the portfolio.
All right. Thank you very much both for that one. I think this one is redirected to DJ. The next question. Will this product be available through Cbox?
Yes, so the fund will be available through Cbox on October 27 for as low as 1,000 pesos. So you heard it right. This fund, which has already been a launched fund since 2014, will be launching the peso class on Cbox for as low as 1,000 pesos, and be sure to participate in that.
All right. Thanks for that, DJ. So again, just to echo on that, this fund will be launched on October 27 for as low as 1,000 pesos. Next one, again, this is for Andy. Is this the right time to invest in US equities? Can you give us a little bit more color on that one?
Yeah, absolutely. So I had alluded to this a little bit in the presentation, and I think it's a really important thing. One of the things that we've talked about and why we focus right now on the US is that the US is a consumption-based economy. Roughly 65% of the economy is based on consumption. Today, due to the high savings rate and due to the transfer payments, i.e. the government writing checks to the individuals in the United States, the amount of excess savings in the United States is $2.7 trillion. Now, this is really important because in a consumption-based economy, you're going to be spending that down. Now, at the growth rate that we're seeing and at the unemployment declines that we're seeing, our research is showing that it will take approximately, on a conservative basis, roughly 4 years to spend down that $2.7 trillion. That means that you're going to have a substantial tailwind to the consumer for the next several years. And that's why we're focusing on areas within the United States. And again, that's why we're focusing on those areas within technology, those tech-enabled companies. And one other thing that I think is really important in the United States is our allocation to healthcare. And this is very simply predicated on the fact that in the United States, you have 10,000 individuals reaching the age of 65 every single day. And this is a trend that is set to continue for the next several years. In the US, we don't have a real nationalized healthcare system. And so what that does is it shifts consumption as well into things like managed healthcare as you get older. So you have a really strong job market, unemployment coming down, a lot of excess savings, and all of this should bode quite well for the US consumer.
All right. Sorry for that. Thank you very much, Andy. Actually, we have a follow-up question. With that, how's the Fed tapering affect the U.S. growth?
So our view on that is that it's a bit nuanced. So if you think back to the presentation a little bit ago, one of the points that we've been making is we're literally talking about the Fed tapering maybe 10, $15 billion a month, whereas the amount of supply that's entering the market is multiples of that. So our point is that actually it should be a really good thing for the US economy for the Fed to begin to taper their asset purchases, because we're talking about normalizing policy and we're not really talking about tightening policy. What we're really talking about is going from those extreme emergency levels back to more very strongly accommodative levels. In other words, it should still be a really good environment for risk assets. But what the tapering should do is take out some of the extra, price inflation of some of the distortions within, say, the fixed income market. Our case on that has been that much of the fixed income market is relatively uninvestable in today. And I think that's a really big deal when you have Rick Reeder, who oversees $2.7 trillion of fixed income assets, saying, hey, actually, we think that there's better opportunities outside of just traditional fixed income. We're going to invest in certain things, but ultimately, we think that the environment is so supportive of risk assets today that we're going to invest that way, and then we're going to balance it out using a healthy allocation to cash to help balance some of that risk.
All right. Thanks for that one. On the next question, I would have to refer this to DJ. What's the YTD? That's the year to date, and YOY or year-on-year return of the ATRAM Global Allocation Feeder Fund.
Okay, we're going into numbers. Thanks for that question.
Hope you have the numbers ready.
So yeah, I have the numbers ready. The year to date of the USD class is 4.31%. This is as of October 14. And the year on year is 11.95%. However, since we're talking about the peso launch of the class, I'll give you a taste of what it would have been like if it were peso. Year to date as of October 20, and we've been tracking the performance of this fund in both US dollar and peso. It's up 11.89%, or in dollar terms, it's 5.79%. So 11.89% in a good recovery year in a fund that is supposed to be diversified across multiple assets. That's a very good return number. So yeah, back to you, JP.
All right. Thanks for that, DJ. Yeah, I could completely agree on the 11% up on despite the current situation. Next question would be for Andy, and I think this is an interesting question. This has been going on for weeks now. With the clamping down of China on the big Chinese businesses and efforts to tighten control over its economy, what are the risks in investing in China?
It's a great question. Look, I think when we think about China, it's a bit nuanced. So I just want to give a couple numbers out there because I think this is why it's important to watch what's going on in China and then think about this from a strategic asset allocation perspective over the long run. So, one of the things that we think is that China actually represents an inconsistent portion of the global equity markets. So just to put that into perspective, as the world's second largest economy, in the MSCI ACWI, it only represents about 4 or 5% of the ACWI relative to the United States, which represents about 60%. One of the other things I think is really important there is, yes, in terms of top 100 companies globally by market cap, there's only about 3 of those that exist in China. The rest of them exist around the world, a lot of them predominantly in the United States. But what's really important and really interesting about China is the fact that the number 2 location globally for unicorn companies, and that's private companies with $1 billion valuation or higher, are located in China. So what does that tell us? Well, it tells us that there's a lot of innovation coming out of China. There's a lot of very specific examples of real new innovative companies that are in China. But it also means that we need to be cautious about where and how and when we take that risk. Right now, we're definitely taking a more observant view. We have about 2.5% in Chinese equities within the portfolio. That's down from roughly 3.5% that we started the year when we had started to take out some profits of the names that had done quite well. And we haven't started to really add back in yet. So, China is an interesting place from a company development standpoint, but it's something that we want to make sure that we're very cautious on given the regulatory crackdown. And we want to let some of that regulatory environment ultimately work itself out and get a better understanding of what that's going to mean for the global capital markets.
All right. Thank you for that. Of course, as you mentioned, an interesting topic lately. Thank you for giving us more color on that one, Andy. I think for the interest of time, we have to take this last question. And this is directed to DJ. So I am a newbie. I just want to expand my knowledge about these things first. What is the best factor to consider in making your asset allocation decision and why?
Well, the best factor really to understand what's happening and how to allocate to your portfolio is really understanding the macroeconomy. What are the factors that are moving equities and fixed income, the business cycle? But when you're a newbie, that can be very challenging, very daunting, especially if you don't come from an economics background, or there are a lot of nuances in the market right now that kind of challenge, common things that a lot of people know about the markets, especially something that Andy said, where fixed income cannot really be used as a hedge anymore to equities as compared to before, where the correlations have been negative. So other than just understanding and really getting into investments, this fund, the Atrium Global Allocation Feeder Fund, is a very quick way to dip your feet in. You get to understand like the insights of BlackRock in determining asset allocation, and from there you could learn from it, and then you could build your base as to which funds you want to add to the portfolio, which funds you personally like, and which funds you think would outperform and really give you more returns moving forward. So the answer is study this fund.
All right. Thank you very much, DJ, for that very insightful, of course, suggestion to one of the questions. Well, I guess that is all the time that we have now for questions. I would like to thank everybody who really made this the Q&A section of our webinar an interactive one. So before we wrap up, how about can I just ask Andy or DJ for any last words before we formally close this webinar?
Just from my end, I just want to thank y'all again for inviting me to speak with you. It's always a pleasure, and for all the people that dialed in, there was a ton of people looking down at the participant numbers. Genuinely appreciate all y'all asking the questions, listening in, and showing the interest.
And of course, thank you again, Andy, for joining us and being here with us and really providing your views on the market. I want to thank everyone for joining and actively participating. We here as speakers see the questions, and we're overwhelmed with all the questions that are actually being asked. And we're really blessed to have a very engaging audience as well. And we're happy that we would finally be able to release the beginner fund, the solution that allows people to just sit back and let people invest. So you have a single fund that manages the opportunities in the world for you. And with the global recovery, why not make the leap and invest with the biggest asset manager in the world in a feeder that invests in one of the best target funds in the world? And invest on day one, October 27. That's the date that we launch it on Cbox for as low as 1,000 pesos. So mark your calendars. October 27, invest on launch and start your investment journey for the beginners and for those that are struggling where to put your money, put it in this fund. So
All
thank you,
right.
JP.
Yeah. Thank you very much for that, DJ. Again, just to echo with what has DJ said. Yes. October 27. Mark your calendars. This will be the first day of our fund. So please do not forget. This fund is really as what has DJ has mentioned earlier. It's good for beginners or to those who wants to start their investing journey. Once again, thank you very much, Andy and DJ. And of course, to all our audience, we appreciate everyone for taking the time to join us today. We hope all of you were able to gain insights and key takeaways from today's webinar. All right. So Atrium has a wide range of investment products, and our capabilities span across several asset classes meant to service different investment objectives for each individual. And with these, it is with great pride that we announce that Atrium has recently achieved 9 industry awards for 2021. First is the Best Local Fund House in the Philippines, given by Asian Investor. Next, the fastest growing fund management company in the Philippines, given by Global Banking and Finance Awards and by Global Economic Awards. Next is the most innovative mutual fund offerings, again by the Global Economic Awards. Next, the best investment solution provider from the World Business Outlook, and the most innovative asset management company from Pan Finance Awards. We'd like also to add that ATRAM Group and the ATRAM Wealth received the Editor's Triple Star from the Asset AAA Sustainable Investing Awards and the Asset AAA Private Capital Awards, respectively, for integrating ESG, that's environmental, social, and corporate governance in our investment process. Finally, we want to say that Atrium Total Return Peso Bond Fund has been recognized by the CFA Society of the Philippines as the best managed fund of the year for Peso Medium Term FVPL valuation category. For today's session, we hope to have somehow assisted you to hashtag take on tomorrow by investing your hard-earned money with an award-winning fund house. Now, as what we have mentioned earlier, did you know that for as low as 1,000 pesos, can already jumpstart your investment journey? Here's how you can invest in Atrium funds.
Hello. To open an account with Atrium, just visit our website at www.atrium.com.ph. Here, you can learn more about all the funds and services that we offer. Our site will then guide you to our online investment platform, Cbox, where you can start investing for just 1,000 pesos. But if you have more questions, visit the website's Frequently Asked Questions page or Atrium Academy page. Thank you.
For anyone who is not yet registered for our webinar next week, Mr. Philip Hagedorn, Atrium's Chief Investment Officer, is set to share his insights and delve in an in-depth discussion on the market performance in our Q4 Market Outlook webinar. You may do so by scanning the QR code, or you may also type in the link found on your screens. Again, for those, if you have any friends who you think would like this webinar that we attended earlier today, but are unable to attend due to various reasons, feel free to share the YouTube replay of this session. You may do so by visiting our YouTube channel, that's Atram Studio. Scan the QR code to visit our official social media pages. Would like also invite everyone to join Atram's official Viber community group. That's hashtag AtramPH community to stay updated on the latest announcements, advisories, and reminders. Scan the QR code or visit the link found on your screen and get a chance to win Atram merchandise. Lastly, we invite everyone to please answer this survey at the end of the webinar. We'd love to know your thoughts on today's topic. On behalf of everyone at Atram, thank you very much for your attendance and participation. Wish you and your loved ones continued health and safety. Have a great day, everybody.